They did the calculation for me then, and they said if I consistently do this, I could pay my mortgage up in like about 9 years or something like that. So I was like, oh, have you heard of mortgage overpayment? Like,
yeah, so backstory, we got a new house last year.
Yeah, last year we moved in. We moved in March 2024.
Yeah. So we moved in as first-time buyers in March 2024. So it's been a year that we've been staying in this house, and the mortgage was an entire process for us, and we had to compare different things when we selected the mortgage we're going for, and we had to put down a percentage. Was it 25?
10%.
Yeah, so we put down 10% for I'm not sure I remember the interest rate.
It's less than 5.22 or something like that.
We got that as our interest rate, 5.22. We had some offering us a lower interest rate, like Lloyds Bank, which was our bank then. But then it did say that we have to pay 25%.
We have to put that 25% deposit,
which at that point we're like, oh, that is a huge chunk of money if you were to invest it in other things, for example, to make more money for you. So the interest rate they were asking for, which was lower than what we got, it does not make sense to just drop that huge chunk of money, which was going to be a huge part of our savings. So we went for the 10%, and we had 5.2 something, and for 35 years. Was it 35 years?
No, so the mortgage is 35 years, but of course we did fix for the next 5 years. Yeah. So after the next 5 years, we can now consider remortgaging and all of that.
Yeah, so it's fixed and then it's variable. And so we were like, for an average person, you just calculate, okay, 35 years from now, I'm going to be done paying our mortgage. Then my husband made an amazing discovery. And we're like, oh, we should share this with first-time buyers as well, so you know that there's an update. You don't have to wait the whole 35 years before
you finish paying the mortgage. Yeah, just to say there that we watched a video from the couple, and they are talking about financial freedom, and they mentioned that they pay off their mortgage within 7 years or 8 years or so.
Yeah.
They live somewhere around Kent, and then he was talking about how if they give him any bonus at work, it moves straight into his mortgage. That if he has excess 300, 500 somewhere, he pays into that, and that reduces the capital. Now, when you overpay, it actually affects the capital, like what you are owing them. And and he said they finished paying off their mortgage within 8 years, less than 8 years or about 7 years or so. I just told my wife one day that after watching that video, because that was where I learned about it, then I went online, made more research, and like, it's possible for us to actually do overpayment in our mortgage.
Yeah.
And if we do, we are going to reduce the term. So we sat down as a couple to look at the pros and the cons that
I'm waiting to get. Before this time, all I know that there is early repayment, which is the concept I had always thought that when we have like a bulk amount of money, we can just pay off the entire mortgage. But then it has a fee that if you're paying this amount, you have to pay extra just to compensate for them. So I'd always thought that was it, but your own method was really, really nice.
Yes. So we just thought that, okay, this mortgage is actually a debt. It's a good debt, not a bad debt, but it's still a debt. And then the earlier we pay it, the lesser we are going to pay on interest. Because if you look at the interest they are paying on mortgage, they are paying nearly 200% or more than also of the amount you are borrowing because it's compound interest.
Yeah, when you want to get a mortgage, they'll give you the analysis to say at the end of 35 years, for example, you would have paid X amount of money, and we're like, oh, well, we're going to be paying back double. But then the truth is, considering inflation and all of that, mortgage is like one of the lowest interest amount loan you can get. If if you have other things, for example, to do with money, it does not always make sense to drop cash for a house if you can get a mortgage. That was our school of thought, that we're like, okay, yeah, let's get a mortgage, but then it's still a debt. So we're like, so that was what prompted us to say, is there a way to actually pay this money earlier as much as possible?
Yeah. So, and as we started doing that research, that journey, we made nice discoveries. We saw online people talking about paying off their mortgage earlier, in their 30s, in their 40s, and for me that struck a chord, because I just felt, why wait until I'm 60 before I will know that, and the house I'm staying, I just felt like that was not something I want to do. I would like to, get that off, because especially in the UK, housing is like the major expenses, you most likely incur.
Like our biggest expense when we get our salary. That's the first huge chunk of money that leaves, and then every other thing goes. So it's always a big expense. So you want to, if you pay early, in a way you're saving yourself a lot of money, like because on that interest that you're supposed to be paying. Because when compound interest is good, if you are the one investing and making the compound interest. But if it's on the other way, and you're the one paying compound interest or something, so the more you reduce the principal amount, the lower the total interest, the money you pay. So for example, if we were supposed to pay, let's say double, let's say £50,000 on our as the compound interest, as interest on the principal that we're owing, just by cutting it off by half will mean that we're now paying £25,000 instead of the £50,000. Now imagine what you can do with £25,000, So that was what motivated us to say, oh yes, let's pay it early. And if we can do that, you can do that. So the way we did it was that, do you want to share?
Yeah, so I think the thing is that after we agreed, I called our mortgage company that we're using, and had a chat with them and let them know that, okay, I want to do overpayment. They say, okay, that's fine. So they told me the maximum threshold I can pay per year, the maximum allowance,
without getting
any fine, payment, without like they charging me extra fee or something like that if I need to. But if I need to go higher than that, then I'm going to incur some charges, as a result of that. So I asked, and the amount they gave me as in a year seems very reasonable, right?
Was it 12K that they said you can pay extra?
Yeah, it just depends on your amount of money. It's not a fixed amount.
Okay.
I think it depends on how much you are paying for the mortgage. But no, how much you are paying for the mortgage, like the worth of the property.
Okay.
But based on the worth of our own property, I think maybe they told me around 15 or how much that is the maximum that I can go per year adding to what we have. So I said, okay. So what we decided to do, we decided that we were going to just increase what we are paying. So what we are paying, we looked at what was coming in. We felt like comfortably we can increase it nearly in about 100%, like almost double what we are paying now. We felt that we should still be comfortable if we try doing that. So that's like we looked at it as another form of investment in a way, because we are trying to cut out unnecessary interest rate. And by the time we agreed to do that, and then when we increased it, we still have a little bit of allowance left on the amount, maybe another 3 or 4K or something like that. And then I asked them, what if I'm still able to pay off this? And they did the calculation for me then, and they said if I consistently do this, I could pay my mortgage up in like about 9 years or something like that. So I was like, oh wow, about 9 years or 9+ years. So that got me. So good. That felt so good when I heard compared to 35 years. I was like, so by doubling what I'm paying, and then at the same time, if I could do this, then I could cut this up. And it felt interesting. It felt relieved. We felt relieved, as a family. And we are on that journey currently, trying to be as consistent as much as possible with it, and hoping that also with the other little allowance that is left, even after the monthly this thing at the end, before the tax year begins, which starts most time by April, we'll look at the balance again, and if we have savings that can cover up that, we'll do that. I have the account, our mortgage account, so with that we could just pay into it, and then I'll notify them, and then by doing that it will reduce it. So we are hoping that maybe if we go this route, maybe in the next 7 years, 8 years or something, we could finish up paying, and then we'll save ourselves a lot of money that would have paid on interest if we continue in this route, and it takes us like 30 something years to be able to finish up paying.
Because for you yourself, even when we first moved to the country, my husband was looking at paying cash for the house, because generally I think as Nigerians we're very averse to debt. Of course, it's the way, it's a norm here, the Western world, to like
it's a credit economy.
So we don't even use credit cards, so that's how averse to debt we are. But just personally would want to like get out of debt as quick as possible. And for you, if you're like a first-time buyer, you're looking at doing that, it does not take so much to move the needle. For example, even if it is extra £50 per month that you're paying, or £100, depending on your financial circumstance, you see, if you call your mortgage company and ask them that if we are paying £50 extra, like just how much, don't just pay the minimum amount that they say you can pay. And this is also applicable to people that have credit cards. Don't pay if they say, oh, this is your interest rate per year, but you can be paying it £200 per month. Ask them that, what if I pay £250? Because compound interest, the way it works is that it will be on your principal. So if you can reduce the principal as much as possible, your interest, that means the money you're giving away essentially is going to reduce. So even if it is extra £50 or £20, call them. It might just be that extra £50 per month can even cut out 5 years from your mortgage, your entire mortgage. So just find a sweet spot that, for example, £50 you used it to go shopping or go to the cinema or something. Just look for one sweet spot that that won't stress you, because that's what we're doing. We're still able to do all the things that we would like to do. We still travel as much as we can, we still buy things that we can, we still have savings as much as we can. So that was one thing. So we just try to do something, the barest minimum that we can afford, and we'll suggest that you do it and call your mortgage guys and see what they're going to say, and see if it's going to make any difference for you.
If you have a question or what we said is not very clear to you, or maybe you have your own experience, you've tried that, it has helped you, let's have a comment from you. Let's have your questions, and we'll try as much as possible to respond.
If you watched this thing, just drop Debbie and Vic in the comment section, and thank you to everybody that dropped Debbie and Vic in the last video. We're happy that you're watching, and we're grateful. Thank you.
Thank you.
Bye.